The reason we love building up flip in our portfolio is every flip we do, it kind of like forward funds the next HMO. Important metric for HMOs is like the scale versus employment. Our current gross income for our portfolio is about 600k. If we were to be paying an estate agent to manage that, we'd be expending about £84,000 in agency fees. One thing I love about HMOs is we're going to do it, go big, because then you actually make income on the management. We target 25% return on cash left in. The reason we target 25% return on capital left in is, one, we want to know what we're getting back on the cash that's gone into it. That's the opportunity cost we're assessing. Two, we love flips in central suites. We've got a few on the go at the moment, actually quite a lot of projects in central suites. But the reason we love building up flip in our portfolio is every HMO that we keep, because we're down south and there's normally quite a little bit of cash equity that's stuck in the deal. Every flip we do, it kind of like forward funds the next HMO. So it works well sort of in tandem there, similar projects, similar conversions, similar build teams, etc. But there's a few important metrics that we actually typically look for when we're doing flips. And some of these are rules of thumbs. Every deal is different, and I obviously recommend you do your own numbers and analysis. But what you probably can't just see on the screen there, on the right-hand side, is I've actually pulled the metrics together of every flip that we've done in the last few years within central suites. And just to narrow down that sort of detail, to do a flip, you've got to do, and I shared this in a previous episode, you've got to buy right and you make sure you get the value. You've also got to make sure that you've got your exit values dialed down. And if you're not buying for the right price, you may really struggle to make that deal work. So the purchase price is really, really key. So a metric to touch on is typically we would like to see a purchase between sort of 70 to 80% of the value of the flip is what you're buying it at. So if it's worth potentially 500k is what it's worth, it's a distressed seller, you're closing a chain, you're getting a transaction done. And I would highly recommend that you try and buy that in sort of 70 to 80p in the pound. That's super important to bake in that value when you buy day one. Otherwise, it's going to be really, really, really difficult to then create value. So that's our average, sort of 70 to 80%. Our then average purchase price to gross development value, which is once we've finished all the works, done all the construction, refurbished it, done a back to brick renovation, we typically have actually bought anywhere between 46% to 68% in purchase price to GDV. Now, purchase price to GDV percentage is a metric, like I said, you've got to monitor different things, but equally, that's a super important metric. We use it in our commercial conversions. I know for a commercial building, we've got to be buying it typically for less than 30% of its GDV. If it's land, it's probably got to be less than 20% of its GDV. And those metrics are really important for speed and to understand what you can get in at. So hopefully that's two important metrics for you. So between 70 to 80p in the pound on its existing value is the purchase price, and between 46 to 68% purchase price to gross development value for a flip like a house to work. The second most important metrics is, we use this within XP Property 2, is 20% IRR is the targeted return that we aim for in our projects. That's obviously anticipated, but we want to make sure that we're hitting about that as a return. The unique thing about property flips is we actually hit quite a low percentage on GDV, so in some cases around 10%. So if we fed selling for 500k, we might have only made 50k net profit on it. So it's quite a low return, but it's a very low risk because there's no ground risk, build up from the ground risk, there's no planning risk. You're normally just in and out, refurbish and sell. That 10% on GDV may have to equate to 20% return on the cash that's gone into the deal. And then last but not least is volume and speed. The longer you take on these projects, the more it erodes the profit. For example, I was chatting to someone the other day who is interested in flips, and I said, you kind of need to do quite a few to make it worthwhile. Ben, you want to go on to the next slide? I'll discuss what we target for our HMOs. One important metric for HMOs is like the scale versus employment. Our current gross income for our portfolio is about 600k. If we were to be paying an estate agent to manage that, we'd be expending about £84,000 in agency fees. So we're now of this scale where it actually warrants us to bring it in-house. We've got an employee at £24,000 per year, and we're making a margin at scale. So one thing I love about HMOs is we're going to do it, go big, because then you actually make income on the management. We target also a 25% return on cash left in without any management fees if it's our own, or if there's management fees, that might be a slightly smaller return. The reason we target 25% return on capital left in is, one, we want to know what we're getting back on the cash that's gone into it. That's the opportunity cost we're assessing. Two, we normally fix our HMOs for 5 years once they've been finished. So I know that within the 5-year term of that mortgage, which is a fixed rate mortgage, well, by the time that we come out of that mortgage, all of the funds and the capital's out. So you're kind of de-risking that particular asset at that time. And obviously that might be borrowed money. So it's also allowing you to be able to pay a coupon on that, whether that be 10% for an example. So you can understand what you can pay an investor to help you grow and fund your HMO portfolio. Another metric that we use, and I actually stole this from Rod Turner, which is 10% return on equity. And what that means is, when you buy, renovate and refurbish a HMO, you could sell it, not typically as a HMO. A lot of the HMOs that we do are kind of family homes that we've generated value from buying well, renovating, adding value, and we've normally got some equity stuck in that project. Now, I want to make sure the return on equity is really strong, because we've had high cash flow HMOs that look really good on a return on cash perspective, but the actual return on the equity is really, really weak. If it's single digits, might not be as enticed to do that particular project. So we also focus on a minimum of 10% return on equity. You can actually see from this spreadsheet, hopefully, that our return on cash left in is 52% per annum and our return on equity is 21% per annum. And this is a HMO that we've just bought. So these are indicative figures, but that is the metrics that we look for from a return perspective. Moving on to stress test. Our stress test in our HMO stuff is less detailed and concerned as our development. Obviously, a development is typically a more riskier play. So you've got to be a little bit more on your onions to make sure that you're actually analysing the particular risk in a development. But for HMOs, we do it too. The main risk on top of build contingency is actually the interest rate that you're going to be paying in the market. So we have 3 different columns, and you can play around with those interest rate figures to scenario when and if interest rates were to go up to 7% for this type of product on a 5-year fix. How does that asset and portfolio cash flow, which is a really key one.